Hello, and a very good evening to all the participants who've joined in this webinar today, where we will discuss our consistent compounders portfolio and all the recent updates related to fundamentals, recent price performance, and more importantly, how the portfolio is currently positioned, in this current environment, where the macro is more subdued. Earnings growth has slowed down quite significantly, and add to that, the recent global events have pushed up risks. So to discuss all of this, we have CCP Fund Manager Rakshit Ranjan on the call. He will take you through his presentation, and at the end of the presentation, we'll have a Q&A session where you can ask your questions. In fact, you can start putting in your questions in the chat box even during the presentation. So with that, I'll hand over the call to Rakshit. Over to you, Rakshit.
Thank you, Arjun. Good afternoon, everybody. Thanks for joining us on this webinar. So starting with the disclaimer first, and then the usual performance chart for CCP versus Nifty. Longer time horizons of 5, 6, and 7 years, the three sets of bars towards the right. They're gradually heading towards the 16 to 17% absolute return objective, net of fees and expenses. That is not the case for the shorter time horizons, however. So for 4 years or less, if you look at the set of bars towards the left half of this chart, the client cohorts are yet to get into satisfactory zone of absolute returns in particular. We are expecting further improvement in all of these shorter term cohorts as well as we go forward. And in today's webinar, I'll give some context behind this expectation of improvement. Context around 3 subjects. Topic number 1, the consistency of CCP companies is earnings CAGR in an otherwise highly cyclical earnings growth environment for the broader market. And CCP's consistency of fundamentals becomes even more important as we are entering into a down cycle for the broader market after a massive 4-year upcycle of earnings growth for major indices. I'll touch upon that as the first subject. The second one, I'll touch upon how quality as a style of investment has historically delivered healthy absolute returns, even during periods of weak earnings growth for the broader environment. Because naturally, the concern can be that if there is no tailwind in the external environment, how can even quality exist within that and deliver healthy outcomes? And finally, just reiterating the key attributes of portfolio construction that we've always followed in CCP and we continue to do so, which should keep us, or rather, which should help us achieve the absolute return objectives of the fund going forward. So starting with the recently concluded financial year on fundamentals for CCP, in FY25, the portfolio's current constituents, which you can see in the table here, the current constituents delivered a weighted average EPS growth of 14%, compared to Nifty 50's EPS growth of 6%. The key factors which compressed earnings in FY25, in a way, the weaker numbers in the EPS growth column, the second last column here, they include firstly a weak macro demand environment for consumption in general. This did affect same-store sales growth for, let's say, the retailers of such as say a Trent or a Metro. For home building materials in particular, the demand environment was weak, which affected Asian Paints and Astral's growth rates as well. Secondly, very high competitive intensity, which did prevail for Asian Paints in particular and Astral as well, I would say. CMS Info was another candidate where competitive intensity was phenomenally high, particularly from Hitachi entering and sort of forward integrating in their services. And in some cases, there were supply shortages. So metro brands with the BIS implementation, or there were massive commodity price inflation headwinds for, let's say, the tea business of Tata Consumer, etc. The biggest factor which supported EPS growth, because there are quite a few healthy numbers as well, the biggest factor which supported EPS growth for CCP in FY25, it included market share gains due to strong moats as an outcome of capital allocation decisions taken over the past few years. So I'll take a few examples. Let's say when you look at Narayana, their investments in the new Cayman hospital, which they did a pretty lumpy one, paid off this year. Chola's investments in new business lines beyond their vehicle financing paid off with accelerated growth rates. Divi's Labs, it invested in building capabilities in new categories like contrast media on the one hand and peptide building blocks, which is becoming more and more topical week after week, GLP-1 and various other peptide building blocks. iShares, Royal Enfield invested heavily in product development for both the bike part, which is the Royal Enfield part, but also for the Volvo trucks. And this was again both for domestic as well as exports market. It delivered rich dividends in an otherwise very sluggish two-wheeler and four-wheeler demand environment for the broader market. Pidilite had invested a lot in products such as, say, a ROF, which was a tiling adhesive, and there are many extensions of that. Jowat, Araldite, the acquisition that they did 3 years ago, you might remember. All of that helped Pidilite deliver a pretty healthy outcome in an otherwise weak macro environment. And one more common factor to the strong EPS growth rate of some of the companies was efficiency gains around tech investments done and process improvements achieved over the last, say, 12 to 24 months. So, for instance, Trent's operating leverage benefits that have started to come through, Divi's, the scale up in Kakinada and the operating leverage there, Dr. Lal throwing off more and more cash using operating leverage as it scales. Metro Brands was a massive positive surprise on operating leverage. Narayana squeezing the juice out of their existing network of beds and hospitals. All of them reported margin expansion due to these operating efficiencies, which contributed to the healthy EPS growth. Now, let's look at the consistency of CCP versus the cyclicality of Nifty 50's earnings growth first. As I said, it's important, particularly in the current environment, and I'll explain why. So this top left chart shows how the CCP's annual constituents, which have obviously evolved over the last 6-7 years, how those evolving constituents have earned their earnings on a 12-monthly basis. So every bar is a 1-year earnings growth of CCP, starting with the date on the horizontal axis. You'll notice CCP has consistently delivered a 17 to 18% annualized return, annualized earnings growth since inception, with limited volatility around that band. When it comes to earnings growth for Nifty 50 index, which are the vertical bars in the chart on the bottom left, Nifty 50's FY25 earnings growth was very different, particularly from the preceding 3 years of FY21 to 24, right? So if you look at FY21 to 24, the post-COVID revenge spending and government infra build-up, government infra capex drive, it led to a broad-based economic growth recovery, right? Which obviously led to most sectors and most players in each sector for the stock market delivering healthy earnings growth. And hence Nifty's EPS growth of 24% CAGR over FY21 to 24. It was a phenomenally upcycle long period phase compared to, say, the cross cycle average, which Nifty has delivered at around 10%. If you look at the bars across the cycle, they'll be averaging at around 10%. Now, as the revenge spending and government's infra capex growth is fizzling away, particularly in FY25, we saw that the growth environment has reverted to a more sedate level compared to what we had seen in the preceding 3 years. This is very similar to the FY13 to 19 period, right? So if you look at this piece, the FY13 to 19, Nifty's earnings growth had actually moderated to hardly 5 or 6%, which is similar to the FY25 growth rate. Now, as we look forward to the next few years, there are several risks that this poses for equity investments in general to begin with, and then I'll come to CCP in particular. Risk number one is valuations currently for the index are at about 21 times FY26 or 22 times there or thereabouts for Nifty 50 versus an average historical run rate of 16 to 17 times over the last 20 years, right? So valuations are at cyclical high. The growth rate, as I mentioned, has started to moderate for a variety of macro reasons. Geopolitical risks obviously add to the uncertainties around demand and supply for various industries. There is a wallet share shift in consumption and somewhat weakness in urban consumption-oriented businesses versus what we had been witnessing over the last 2 decades. And last but not the least, the pace of disruption of incumbent business models has accelerated for sure, because physical and digital infrastructure, as it has developed, it has allowed new entrants to scale up their businesses at a far faster pace than was possible perhaps 10, 15 years ago for new entrants at that time. So the big question that I think all of you need to then answer as you look at CCP, and we'll dwell upon that, is that if Nifty 50 is lacking earnings growth, and if we are perhaps coming off a upcycle and heading into a down cycle, perhaps, or mean reversion at least, then why should one stay invested in a portfolio like CCP as well? Because after all, the quality universe is a subset of the broader universe, right? Many clients have told us quality doesn't exist in vacuum. It's a subset, and hence, to what extent does it make sense to stay invested in quality as a style and CCP as a product based on that style? So to answer that question, I think it's worth looking at this table on the left with 3 broad columns indicating, first of all, the broader market growth rate in terms of earnings, which is represented by the Nifty 50 EPS here. Secondly, absolute performance of quality as a style over the last 2 decades on an annual basis. Now, this we have tried to represent using an index, an SE index called Nifty 200 Quality 30 Index. This is an index that was created more than 2 decades ago and is a subset of the sort of Nifty 200 broader index, which is the quality definition of NSE based on ROCE and quality of modes, etc., as per the exchanges. And the third column is the alpha of Nifty 200 Quality 30, or let me just simplify it, call it the alpha of quality over the broader market, right? That's the last column. And the blue to red shading has been done for each column to make it easier for you to understand the comparative trends. What you can see clearly here is that there's a negative correlation in the shading of the first column and the shading of the third column, right? So for the encircled bits, let's say the first encircled bit and the third encircled bit, that is an upcycle earnings growth for the market. And you'll see a negative correlation of relative return at least for the quality style in an upcycle of earnings growth for the market, right? There's an underperformance, effectively, when the EPS growth for the broader market is in euphoric zone, there are reds in the last column, right? So quality as a style underperforms. The longest and strongest series of blue shades in the EPS growth column were the last 4 or 5 years, right? The 2021 to 24 period, as I said, which was also the longest and strongest shade of red in the last column, right? Where quality massively underperformed as a style, which explains to an extent, I know not fully, but to a great extent, it explains what CCP investor cohorts of the last 4 years have also gone through, right? Which was the first slide of performance that I showed you. Now, let's come back to the question of what if the next few years constitute weak EPS CAGRs of, say, mid-single digits at best for the broader market. To see an example of that kind of a regime, that kind of a external environment sustaining over several years, I think it's worth looking at the FY13 to 19, where you can see the spotlight, the cursor. Nifty 50 Quality 30 delivered healthy absolute returns, even when earnings growth was mid-single digit for the broader market, right? So forget about the relative return piece. Obviously, that will happen as an outcome. And also in CCP, given that it's a far more absolute return oriented portfolio construction approach, relative return outcomes are just outcomes. They are not the targets, or they are not the inputs. The inputs are absolute returns should be good, which the Quality 30 index is demonstrating. It was actually 17% CAGR, not too different from the cross-cycle 18% CAGR, right? So I repeat, when earnings growth was 5 or 6, when earnings growth was 5 or 6% CAGR for the broader market, absolute return of the quality index defined by NSE was about 17% CAGR, not too different from the cross-cycle performance of that same index, which was about 18. Right now, why does this happen? There are several stock-specific factors which benefit quality companies. The classical factors, attributes of quality around moats, capital allocation, operating efficiencies, and hence market share gains, which explain this. Right now, that then brings us to CCP, and what are we doing there? How should we view the prospective performance experience from here on, given how the external environment is evolving? So to begin with, we remain focused on these classical attributes of high quality businesses, deeply moated core franchise wherever we invest, which should lead to high ROCEs. Those high ROCEs should get reinvested at a healthy rate, as in the proportion of capital getting reinvested from the capital that was generated. That proportion should be high, and there should be prudence in that capital allocation, which leads to reinvestments delivering healthy earnings growth, because you need to have conviction, confidence in high ROCEs, even on the incremental capital deployed areas. And behind all of this, there has to be a high quality management team which sustains this process of moat to cash generation to reinvestment, and hence growth delivered through capital allocation. Needless to say, if we pick up the right set of stocks in this manner and build a very concentrated portfolio in an environment when there aren't too many companies delivering growth because tailwinds are missing, then portfolio concentration becomes an added strength, right? The more say widespread the stock selection becomes in terms of number of stocks per industry, number of industries across the economy, etc., the greater the risk that in an otherwise narrowing earnings growth and narrowing stock market environment, is there going to be adverse impact of too many stocks? I leave it to different fund managers to because there are various ways of making money, and I'm sure there are other more diversified portfolios which will do well. But portfolio concentration is our strength at Marcellus, at CCP. And the strength of portfolio concentration gets amplified in an environment like this, where bottom-up competitive advantages and capital allocation drive earnings growth more than tailwinds from a macro perspective. Now, last but certainly not the least, valuation prudence is important, because, as I said, one of the biggest risks that exists today is that the broader market is trading at rich valuations, 21, 22 times 1 year forward, and many quality stocks are also trading at premium valuations. So when we are trying to pick stocks in CCP, there are two types of stocks we have in a way bucketed the list under. So type 1 is undiscovered quality, and hence the upside coming from the discovery itself. That's the ideal type of stock picking, where quality companies with healthy expected earnings growth are also trading at low valuation multiples, and hence it is undiscovered. The best example of this was, I would say, over the last 12, 18 months, Narayana in our portfolio. When we picked it up, it was pretty much 1/3 the valuation of most other large listed hospitals on an EV/EBITDA basis. More importantly, it was highly underappreciated for its ability to deliver capital allocation outcomes far superior to the rest of the sector. Even today, I would argue that continues to be the case. When you look at Narayana's valuation multiples today, about 26, 27 times EV/EBITDA compared to 30 plus for the broader market. And then you also factor in the degree of disruptive capital allocation attempts being made here, which can actually deliver not just sustenance, but radical disruption on the rest of the industry over the next, say, 5 to 10 years by trying to address the conflict of interest that exists in healthcare in general. Where there's a conflict of sort of hospitals getting benefited by quaternary and tertiary care treatments being given to patients rather than being benefited by patients staying healthy, right? That's a massive conflict of interest, and there are I can go into further details of this if somebody is interested in the Q&A. But that's a perfect example of quality, underappreciated, high growth expectation, and we build a large position. Unfortunately, we don't have 15, 20 such stocks from our coverage universe, so that we can all call them undiscovered quality. Hence, part 2 of the valuation based discovery or the valuation based stock picking is part of our portfolio. You can in a way call this as discovered quality of the core, but many areas of positive surprises in the times to come, which are not baked into expectations of the broader market, and hence scope for earnings upgrade in future, right? So the one good example of this is Trent, let's say. So Trent was a stock which, when we picked up, it was trading at a very high price to earnings multiple, but that multiple was high a lot more optically than otherwise, because its initiatives around growth, cost savings, disruption in new retail formats, they were just not baked into the earnings at that time. Even today, I would say, when you look at what they can deliver through operating leverage, given the initiatives taken as recently as the last 6 months, right? Whether it be in Star Bazaar and Westside and Zudio, RFID tags, or faster checkouts, or automation of the back-end procurement supply chains. There are many areas where employee cost counts have gone down. The full effect of that is yet to be baked into consensus estimates. Last quarter was the first time when that positive surprise was delivered upon, but there's a lot more, I guess, that is likely to come through. Then, when you look at Star Bazaar and the value add that it provides, particularly around fresh fruits and vegetable, which requires farm to fork back-end integration, private label products across personal care, home care, packaged food, etc. And as a result, a massive value add on the whole when added with Zudio compared to, let's say, some of their competitors, where their apparel would be far more inferior proposition on the whole compared to Zudio's proposition. Star Bazaar becomes a package of fresh, private label, and apparel and general merchandise in a very superior format, which I'm reasonably convinced has very high scalability and ability to generate cash that is not adequately baked into the current earnings expectation. So although Trent is recognized for its quality as a franchise, when you look at the price to earnings, there is no discovery element left around that measure, but there's earnings surprise possibility. That's exactly how the investment in Trent has played out in the last 1 or 2 years. That's exactly how we expect, despite whatever 80, 90 times 1 year forward price to earnings, we expect Trent to be a contributor, a positive contributor to our overall portfolio's performance. Now, when it comes to the blended average P multiple of CCP, today 1 year forward P is in the low 40s, which is not cheap when you compare it with, let's say, 21, 22 times for the market. But when you compare the fundamentals of the market versus CCP, earnings growth and ROCE both are roughly twice that of Nifty 50 for CCP. And hence, at the bare minimum, 2x price to earnings gets justified from superior fundamentals there. On top of it, add to its sustainability and perhaps some optionalities, which are not yet baked into, as I said, some of the earnings growth numbers. There could be some upside here. So that's on the absolute valuation relative to Nifty 50's PE. But when it also comes to, let's say, current PE multiple of CCP versus the last 6-7 years of various CCP portfolios at various points of time, it's a reasonably bigger discount. Also because quality as a style has not done as much as the earnings growth for some of these quality businesses did over the last 3-4 years. Hence, the PE multiples have compressed in some areas. It's also because we have picked up intentionally and loaded up intentionally on some of the more undiscovered quality type of opportunities, the way I was talking about Narayana, let's say, as an example, right? Overall objective of the valuation approach that we have in CCP is that the pre-fees fund performance should be better than the EPS growth that we earn over, let's say, the next 5 years as a time horizon or longer. Just to remind you, in the last quarterly webinar of CCP, which we did in February this year, we had quantified that since inception, CCP has delivered a fund performance only in line with its 17 to 18% earnings growth CAGR since inception, before fees and expenses are deducted. That delivering fund performance in line with earnings growth pre fees and expenses is something that we want to better going forward, where historically valuations on the whole have neither added value nor destroyed value since inception, although there have been periods, particularly the last 3 to 4 years, where valuation has contributed negatively. Performance of the fund has been behind the earnings growth versus the first half of our journey, where valuations had contributed positively and performance of the fund was better than the earnings growth. Going forward, cross cycle, rather than a zero benefit, we want a positive benefit to come out of our valuation approach. So that's the objective, and hence bucketing stock selection in these two areas. I'll conclude my opening presentation here and will request Arjun to moderate the Q&A session. Over to you, Ajay.
Yeah, thanks. Thanks, Rakshit, for discussing all those aspects. To all the participants, if you wish to ask a question, please type in your question in the Q&A box, and we'll be happy to answer them. There are already quite a few. So I'll start with more at a broader portfolio level. So question comes from Ramesh Sheshadri, who asks, are we going to see a higher portfolio concentration in CCP going ahead, given what you discussed, Rakshit, of a narrow market, slower earnings growth? Are we going to see a higher concentration? And if yes, how many stocks will the portfolio consist of?
Right. So let me quantify where we stand today to begin with, so that it puts some context to it. So today, the top 6 stocks in CCP, they contribute to 50%, 50% of the portfolio allocation. Top 10 stocks are 2/3 of the portfolio allocation. And top 15 stocks are 90%, 90 of the portfolio allocation. So top 6 is 50, top 10 is 2/3, roughly 66, 67. And top 15 stocks is 90. That's the current portfolio allocation. Overall, on the whole, we have at the moment 20 stocks because the tail is the last 4 or 5 with barely 1 to 2% each, etc. How do we see this going forward? So as time progresses, if we do get convinced more and more around some of these stocks and we see lack of correlation of risks, so let me call it, if uncorrelated risks with a little more concentration can be sustained in the portfolio, then we will increase the concentration from here. Otherwise, you might see the top 15 contributing to 90 rather than the top 12 or 11 contributing to 90% of the allocation. So to that extent, I think we will remain very conscious of the risk reward. If we can get uncorrelated risks, rather than have 5 or 6 stocks in the top 10, all catering to the same types of value adds, same types of external environment, same types of risks and rewards. If we can have uncorrelated risks in the portfolio whilst increasing concentration, we'll be happy to do it. Otherwise, this is pretty much where we'll sustain for the time being. There's a related aspect to correlation here. The top 4 or 5 stocks which have had a sizable allocation each, as in 8 to 10% each, in some cases going up to as high as 11 or 12. This will be a subset of 90% allocation coming from the top 15, right? Because only then can you benefit from position sizing within a concentrated portfolio. There are flip sides to this, as in there are short-term risks that you need to be aware of. There could be 3-month periods where if 1 out of the top 4 or 2 out of the top 4 go through a bit of a drawdown, they drag the portfolio performance down. Net, as long as our hit rate on the larger allocations is higher than the hit rate on the overall portfolio, and as long as our hit rate on the overall portfolio is greater than 50%, in terms of decisions which created an upside versus decisions which created a downside, I think you'll have more upside risks to the concentration of the top 4 or 5 stocks than downside risks to the concentration of the top 4 or 5 stocks. And in a way, the journey of the last 7 years, including, let's say, the journey of the last 6 months, has been similar, right? So we are very conscious of that. As a result, 1-month, 2-month timeframes will tend to be volatile. They will be feedback that we will receive at that point that, look, you guys invested so much in one stock, and that one stock has gone through a 20% drawdown because of weaker than expected results, etc. Your position sizing is too risky. But net over a 12-month roll, we expect, or in fact longer, I would say, 12 to 36-month roll or longer, we expect portfolio concentration to add more value than it destroys.
Right. Two other, broader portfolio level questions. One, we've answered this in our previous webinars, but quickly, if you can just lay down the reasons why in the current unfavorable macro environment, why don't we have a higher cash, position in the portfolio?
Yeah. So look, I'll maybe rattle off my thoughts on this point. So first of all, let's understand that the opportunity loss of staying in cash and the portfolio not falling, right? So you stayed in cash, the portfolio didn't fall, it actually went up. That opportunity loss is far more permanent than the opportunity loss of staying invested through a fall in the portfolio, right? Which is to a great extent recoverable, because in the long term, the logic stays that earnings growth will drive 80 to 90% of the share price of a stock. If our stock picking isn't faulty, more often than not, again, it's not a 100% hit rate, but a reasonably high hit rate of stock picking, then at an overall portfolio level, the long-term trajectory of the portfolio for various time horizons will tend to be positive with a higher probability than negative, right? And as long as that probability is more towards positive returns than negative over a certain time horizon, sitting on cash and facing the risk of the fall that you expected because India-Pakistan went to war and they did go to war and still the market didn't fall, right? That risk of opportunity miss can become permanent, because once the share price goes up, because the earnings have gone up and the India-Pakistan risk didn't play out, you can't recuperate from that lost upside by sitting on cash. But if you were invested and there was a shock to the broader market or to, let's say, liquidity or share prices, etc., which are not related to long-term earnings, if you're invested and the share price falls because of those external factors or some other reason, then it's still possible to recover. Most likely you will recover because the earnings growth is high. Related to valuation as well, there are certain stocks in our portfolio where, let's say, our exit PE 5 years down the line, if we have to exit, our exit PE is, let's say, 20% lower than current PE multiple, right? Now, the question then becomes, will this derating, which is expected, will it happen over a 6-month period or will it be gradual and happen over a 5-year period? If it happens over a 6-month period, the PE derating will more than offset the earnings growth over that period, right? And hence, you should have actually sat on cash waiting for a lower share price. But if it happens gradually, as in, let's say, if the earnings growth of the said stock, for an example, was 20% and the PE derating is 5% annual, you'll still have the stock deliver a 15% annualized return, give or take. And staying invested is a better outcome than sitting on cash in that kind of a scenario, right? So that's the second piece. The third piece is, it's very hard to jump back in with logic, even if your call of sitting on cash has gone right, because the markets won't wait for logic to be visibly available to everybody that there is a bottom now for the stock or for the market or whatever, right? So even if you sat on cash and the share price fell, it's a skill set that, at least, let me be very honest, we don't have to a great degree, that will jump back somewhere during the fall. Obviously, nobody can time the bottom, but somewhere during the fall before there's a massive recovery. Because if the shock is something that goes away in a short period of time, the rally will be at times sharper than the pace of decline, and we'll not be able to jump back in to benefit from it, right? So that's the third problem. Now, as a result, I would rather cut down position sizes to bare minimum levels in stocks where there is a risk of forthcoming challenges, right? There's a risk of emerging on the horizon. I'll give you an example. Let's say Bajaj Finance and Titan, what we did with their position sizes is how I would like to play at a stock specific level risks that can really bring the share price down in a meaningful way, right? Titan, we've always kept talking about. The risk that was always on our mind still is lab grown diamonds as a concept if it picks up. And regardless of whether Titan makes it trustworthy, if lab grown diamond picks up as a proper trend, or whether somebody else does, there will be an adverse impact on the margins of the incumbent business that Titan has. And in order to protect from that, at a point when Titan's PE multiple was 70, 75, had it been 30, 20 times PE multiple, the risk might not have played out as sharply, even if it did, right? So rather than saying that, look, these kinds of risks are there, let's just completely exit, I would instead take the position size down to a bare minimum level where it stops hurting the portfolio performance, but also leave the optionality of jumping back in at a faster pace if the risk goes off from the horizon. This has worked well for us on Titan. It hasn't worked well for Bajaj Finance. On Bajaj Finance, the risk was the personal loans and unsecured loans in general going through a cyclical downturn for the market as a whole, and Bajaj is more exposed than most lenders outside. Despite being a good lender, they can be a shock to the system, then to the share prices of all the larger players, etc. Right? So I would rather try to play it in that manner rather than take a 30-40% cash position, particularly because these are high quality franchises, right? So some of Marcellus's other portfolios have taken cash calls because they invest in franchises not with a 5 or 10 year horizon. These are not franchises which have repeatedly demonstrated in the other portfolios. They are not the franchises that have repeatedly demonstrated over several decades in the past ability to overcome crises and actually benefit from them, right? So the nature of business that we invest in CCP is different from the nature of business that some of my colleagues invest in via LCP, RG, MCP, etc. And hence the sort of logic of cash call becomes very different, right? The way a risk can play out in a high quality business is very different from the way it can play out in a let's say not yet matured franchise elsewhere.
Right. Fair enough. In fact, there were a couple of related questions which you've already answered now. By in terms of why the cash position is so high in LCP and which is in stark contrast to what we see in CCP. I think you already
Correct. So
that.
yeah. So sorry to interrupt, Arjun. So let me explain the risk a little more. It is not just the fundamental risk. There's also a liquidity risk. Right. So the smaller companies will undergo massive upside risk and downside risk because of liquidity. They will undergo massive upside and downside risk because of fundamentals, and they'll also undergo massive upside and downside risk around discovery. Whereas the larger companies will have more moderated risk around discovery, around liquidity, around the ability of the high quality management team to actually benefit from the crisis. Right. So that's why in a way, divergent logics for very different types of stocks being picked up in two different portfolios.
Yeah, and more generally, as a segment, we are a lot more bearish in some ways on the small cap segment. I think, of course, market wide, valuations are elevated, but I think in the small cap segment, they're too excessive.
Yes.
From that perspective, we do see much higher risks on the small cap side of the market, and therefore a large cash position. So I guess that answers the question.
Correct. And also, Arjun, one other way to put this is, in CCP, we've always maintained that we expect 80 to 90% of the portfolio performance to come from earnings growth. Right? Obviously, historically, it's been more like 100%. We don't want 100. We want positive contribution from valuations and other factors. But we don't expect less than 80% contribution over a 5-year roll or a longer time period to come from earnings growth. And hence, the willingness to play via discovery, via valuations, via cash calls, via entry exits, the willingness to play those elements of investment is less here than in, let's say, LCP. In LCP, the objective of the portfolio is far more discovery oriented than in CCP. CCP, we do intend to benefit from discovery, as you can see on this slide, first point on the right, but that's not a larger part of the overall objective compared to LCP.
Yeah. Right. Before I jump on to more, stock specific questions, just quickly, Rakshit, one question on how do you determine, when to exit a stock from the portfolio, especially one that has perhaps passed the high barriers to entry, or I think what the question means to convey is, I think also conveys that competition increasing, other players entering into the sector. How do you determine, when do you think is the right time?
Yeah, so there are different factors, I would say, if I were to classify them. Type 1, moat is disrupted, right? Moat doesn't exist anymore. It could be because of a bad capital allocation decision, which has destroyed the moat. It could be management succession change, which means the decision making is far inferior in quality. It could be external paradigm has changed, customer preferences have changed. If there is near tangible evidence of at least start of the moat's disruption or overnight complete disruption, it is the easiest call. I mean, the success rate of that kind of an exit call is reasonably high, right? So, for example, September 21 Relaxo exit from CCP. For example, I would say we had a few exits from FMCG companies in 2019, and they've played out well. So, if that is clearly visible, success rate high, logic is straightforward. But then comes other types of decisions, which will have perhaps slightly more difficult success rates, relatively more modest ones. So let's say, I'll give you an example. So earnings growth is expected to be more moderate than in the past, and we have a substitute in the form of stronger earnings growth that can come into the portfolio. Take, let's say, stock A, stock B. Stock A, previously 20% plus earnings growth expectation, now 13 to 15%. Versus stock B, 20% earnings growth expectation, even now. We'll try to swap. The challenge will be 13% or 15% on stock A is not a significantly bad earnings growth, maybe is already baked into the near-term expectations, and the company being a high quality company, but in a saturated market, it throws a positive surprise. The high quality aspect of the management, they throw a positive surprise, which creates an additional layer of expectation from future earnings growth for the broader market. Whether or not that company delivers on it, the share price doesn't fall. In fact, it keeps going up. And we have exited, right?
So basically, you're somewhat sort of alluding to like relative risk reward.
Relative risk reward, right? So the sell decision in this case optically will appear to be a bad sell decision, because at the very minimum, 8 to 10% share price return is possible after we exit, which actually is a weak return, but it's a positive return. We exited at a certain share price, and thereafter the company is at a higher share price. And we've had cases like this in the past. Let's say one tobacco company we exited, and for a very short period of time, the share price CAGR was very high. That will mean reward as well in the long run, but that happened. What is better to assess is the substitute. Is the substitute higher quality franchise or higher earnings profile franchise, and hence net is a risk reward a better decision that we went after. When you do it like that, the hit rate of a sell decision might be still a very high one. But on a standalone for the exit, it might appear to be bad. The third piece is there was intense competition in the short term. Nothing changed from a long-term perspective. In this case, the ideal scenario will be we should have been able to foresee the short-term risk, trim the position size, just like we did for Titan or let's say Bajaj Finance, and then make an attempt to go back in. There have been cases in the past where, let's say, a Dr. Lal in Asian Paints, in our view, the quality of the franchise from a long-term perspective hasn't changed, but the short-term risk that appeared on the horizon, we didn't react more proactively. Now, that reaction again, proactive reaction, will be dependent on our ability to find a substitute, which is as convincing from a long-term perspective without the risks from a short-term perspective, and hence the swap makes sense. I would say till 3 years ago, given the relatively narrower coverage of sectors and companies within sectors for the broader CCP basket, which over the last couple of years through various webinars, we've tried to explain what has changed in CCP's approach towards portfolio construction. The wider coverage, more options available for substitutes, it helps you take these calls more and more. And then even if we trimmed Bajaj, there was a Chola which did well in the portfolio, right? We eventually benefited from lending ecosystem investment. So we'll try to do better, but yes, historically, in this type of sort of short-term weak, long-term strong, we weren't proactive, and the sell call wasn't taken on time. That kind of a risk existed in the portfolio. We'll try to reduce it going forward.
Yeah. On that note, I think this is an excellent time to go into a discussion on a stock, which obviously we have the maximum number of questions on that, which is Asian Paints. I think you've partly already answered what we should have done, which is trimmed down the position. But I think the broader point here is what you mentioned about your view on the disruption, or let's say competition coming in, which obviously there's some disruption at this point of time, which you think is more short term, and it'll sort of even out over a medium to longer term period. So I think maybe you should just expand on that a little bit, because the question really is, so one aspect is this, that given competition coming in, etc., why did we not take any action? And the other side, the other part of the question on Asian Paints is what you discussed earlier about the weak macro. So given the slowdown in urban demand, Why is it that we still continue to hold Asian Paints at this point of time?
Yeah. So look, there are various ways to answer this, and then join the dots after covering all those ways. So first and foremost, let's say Asian versus Astral, right? Interestingly, both are from home building materials. In both the cases, demand is incredibly weak. In both the cases, share price reaction is also very similar. Astral doesn't have an opus. Asian has an opus as a competitor, which is in the narrative. Now, this is where I think quantification is important. We are very clear in terms of last 12-month progression in the paint industry. Had Birla Opus and the competitive intensity from that not been there, and we would have been in a normal competitive environment, Asian Paints' revenue growth at best would have been 3-4% higher than what it was. It would not have been 20% higher, 15% higher, right? So the revenue growth muted numbers that you saw, and the earnings growth muted numbers that you saw on Asian over the last 6 quarters. To a significant extent, that is because of weak macro. Now, I would say the more important question to be asked is, high quality companies, they come out with newer ways to grow earnings in a weak economic environment. Why didn't Asian Paints do that? I think that's a far more relevant question than Birla Opus. Birla Opus is a threat. Birla Opus hasn't yet been the biggest reason for Asian Paints' earnings growth moderation and hence the disappointment. Although in the narrative, I would say, and hence the share price reaction, probably Birla Opus has a far greater contribution than the macro. Why did Asian Paints come out with Brahmastra against the macro? At one level, I mean, I would say we are disappointed that their backward integration plans were far more out in time than perhaps what could have been ideal in terms of the white putty, their VM, VAE, etc. That could have provided a massive downside protection. Their category expansion, their home improvement segment hasn't become as successful as we would have liked it to be from a high quality business. So some of those decisions, I would say, from a timing perspective, didn't create an offset versus a weak macro. Had they done it, maybe home decor for Asian Paints or maybe backward integration for Asian Paints would have been. And hence, at any point of time, a high quality company would have several optionalities, some of which can then play out during periods of a weak external environment. It didn't happen. We do see some of these offsets, particularly the backward integration piece, play out in favor over the next 24 months. And hence there should be an end to the pain or reduction in the pain. Let me put it like that. If the weak macro continues, coming to their, I would say, competitive positioning. It's important to understand that the moat here was supply chain velocity. That supply chain velocity feeds into inventory turns of the dealer, which feeds into the ROCE of the dealer. When there are no footfalls because the macro is weak, and by the way, paint macro has been this weak for the first time in the last 25 years. We haven't seen in any other kind of an economic downturn or a consumption downturn, paint industries macro, because it's repainting cycles. They keep coming through. It's an expense at a household level which doesn't happen every year. It's not recurring. It's recurring over a longer cycle period rather than annual or 6 monthly. And hence, it sort of has a lot more resilience rather than being linked to the real estate cycle or being linked to some other highly cyclical external factors. When the footfalls are weak at a dealer's shop, the ability to make money for the dealer via inventory turns is far lower than the ability to make money via margins, right? So the dealer then, in a weak macro like this, what we've seen in the last 1.5 years, is the dealer doesn't appreciate the supply chain velocity of an Asian Paints, which is the competitive advantage, as well as the dealer would appreciate in the normal macro. In the normal macro, footfalls are coming through, inventory turns become very important, right? When nobody is coming to your doorstep, then whoever comes in, if they give a higher margin, that is the only way to drive ROCE because inventory turns can't. So to that extent, this is actually applied to even Astral. Astral versus competition, Asian versus competition. For both these companies, uh, uh, supply chain was a big part of the moat, is a big part of the moat, which becomes more important for the channel when the macro environment is far more normal. So that's on the whole, our view on Asian. Uh, just remember, we've been through a, a, a different variant of this with the Dr. Lal Path Labs example, where position sizing actually became a bigger offset than buy and hold of a Dr. Lal. Even in Asian Paints, we did trim a little. We could have trimmed even more before the share price stagnated and crashed, brought it down from 10 to 7 or something. But yeah, it will be an opportunity to benefit from position sizing as an offset here again, perhaps, and we'll try to do that. So, yeah, that's the view on Asian.
Yeah, in fact, your point about disruptions being short term in nature, I think it's already played out in Dr. Lal's case. Of course, diagnostics as a sector does see competition coming in every 4 or 5 years. Backed by hot money or whatever VC money whenever the environment is right. But it has already played out there. Concerns that people had 2 years ago about Dr. Lal losing market share with the new entrants. I think I think that fizzled out long back, but I think it's now showing up in their numbers as well. But a related question is on the recent news of JSW acquiring Axo's business. Does it have any sort of impact
We'll see. See,
on?
as long as Axo's business itself is concerned, I mean, Dulux was not a weak proposition from a product perspective. It was actually a much stronger proposition compared to any other product in the market. It was Velvet Touch particularly. So the acquired asset wasn't weak to begin with. It was always in existence. Does JSW's takeover create additional competitive advantages for Axo or for Dulux incumbent franchise? We'll see how it progresses, and we'll take a call if we see destruction of modes for Asian here from a long-term perspective. As I said, that will be the easiest call to exit.
Right.
Yeah, yet to come.
And would it have made any sense for Asian Paints to acquire Axo's business? Would it have made any sense for them?
I think given the pricing at which bidding was going on, for Asian, it made far less of a sense than for, I would say, I don't know, JSW maybe. Certainly, there were a few others also in the fray. For different reasons, they had rationales. But for Asian, given the valuations that they would have had to pay, given their existing market share already and the moats already built in, maybe not. But yeah, I mean, Asian Paints is a better judge at this. We are only going to analyze the business quality post corporate action like that.
Right. I'll throw in one question from my end, the last one on Asian Paints. So given the price erosion that we've seen, and the point that you made that it perhaps reflects more of the worries around competition rather than the weak macro. So at current levels, how much of these two risks, how much of these risks are already priced in? Do you think it's adequately priced in, or if you think the entire fall in the stock price was because of competition, macro is yet to reflect in it? What's your opinion on that? I mean, does it make sense to exit Asian Paints at these levels? I mean, let's put it bluntly.
I won't like to answer it straight away. All I would say is we are still invested.
I think that answers the question.
We might
I think
exit, we might double down.
the answer was within my question itself. So there you go. So right. Moving on. Other stock specific questions. Again, a few of these related to newer or emerging areas, AI being one of them. How do we intend to take any sort of exposure? We already have some exposure through HCL Tech, but the question is why HCL Tech and why not TCS? And the other question, I think when you answer that, I think the other question will also get answered in terms of whether we intend to take any exposure to a growing area like AI.
So, I mean, HCL Tech versus TCS, we have had TCS in the pre-AI approaching era. And now we have HCL Tech. The answer is simple. I'll make two quick points. One, HCL Tech is a far more capital allocator oriented growth company than organic same old being done in a better way in future, which is TCS, right? So to that extent, as we go through this transition in the external environment, AI is one of the bigger pieces of it, and there are many second order and third order effects of AI which are leading to the external environment possibly transitioning. Capital allocation skill sets become more important in pivoting the business model from the old paradigm to the new paradigm, which is one way to answer. The second point is TCS, given the business model versus HCL Tech, given their business model. The difference is TCS is far more high volume, low value add workforce as part of the moat compared to HCL Tech, which is slightly more premium value add, relatively lower volume workforce as part of their moat of the core business. And hence, I would say the inertia that we see as a risk for any IT services company as they pivot in the new world where higher value added talent will be more in need, perhaps at least in the foreseeable future, compared to mass scale execution oriented base of talent, which I would say TCS is more strong at. That's the other area where I think pivoting from the old paradigm to the new paradigm, even on an organic basis, we believe might be better investment proposition via HCL Tech than via TCS. Having said that, TCS is a phenomenally high quality company in terms of the management team, the decisions that they've taken in the past, and hence there may be ability to pivot in future as well. But we've taken the risk reward into the equation and gone for HCL Tech.
Yeah, better risk reward. I think that's the answer. So there are other questions on some of the underperforming stocks, and you can take them one by one. Alchem, why we buy such a high price, and then we've sort of trimmed it down.
Expectations have changed for us. It's not the same expectation when we bought versus now. Expectation of the market industry growth itself has changed. On top, our understanding of how quickly can Alchem pivot from the old Alchem to the new expected Alchem in various dimensions. those expectations have sort of moderated more because of the longer time that we see the business is going to take, and it's a substitution effect as well, as in there are other options where similar money has been allocated. Yeah.
Right. Then, a slightly higher allocation stock, which is CMS. I mean, why have we bought CMS?
Yeah. Why have we bought? So, first and foremost, we haven't bought it because we thought number of ATMs in India will increase, right? We are very, very conscious of that. We haven't bought it because we thought UPI will not affect cash in circulation. We are conscious of that risk as well. We bought CMS because one, their core business, which won't grow at a very fast pace, which is the ATM management piece. That core business is highly cash generative. They have really deep-rooted moats. Growth potential is limited, but the moats are significantly deeply rooted. That's one. Second, there's a massive network effect that CMS creates from one type of offering for the same client to multiple offerings for the same client. It also creates massive efficiency effects of scale, even though low top line growth, higher earnings growth on the core, where route efficiencies, adding newer relationships to the same route, to the same set of services that they are already offering via fixed costs, and hence scalable revenues, operating leverage, etc. So that's a very big piece. And then comes the final piece, which is capital allocation beyond core, which they have done very successfully via M&A. They are sitting on, at the moment, more than 15% of the market cap as cash, a very high quantum that creates optionalities. Some of those optionalities are already in motion with their sort of predictive analytics business, which they are offering to ATMs to begin with for surveillance, security aspect to begin with the cameras related service. And then there are many other use cases that they have started to explore, experiment, some of which might become scalable. So it's a combination of that. So the core being a cash cow. Secondly, on a small revenue growth, the core being high operating leverage. And then most importantly, one of the biggest parts of our investment hypothesis here is the optionalities. And we do not think that the share price bakes in these three elements adequately.
Right. Then moving on to another stock which has actually been one of the bigger drags on the portfolio, Tube Investment. What is it that we are seeing that the market is not?
To begin with, I would say there's a kind of a big opportunity on the SOTP valuation part, right? So which we have perhaps gone into in the previous webinars. Secondly, when you compare the expectations from some of the capital allocation decisions that are baked into the price, which in a way is an extension of the SOTP argument, some of the expectations which are baked in compared to when you go to the ground level and see initial success of some of those capital allocation decisions, you see the proof of the pudding, and hence the scope for upgrades. And finally, just like I was talking about CMS, core business here as well is a very high ROCE cash cow, which is used to fund non-core, so far with reasonable success, and in future we expect more fit.
Right, and a related question to that is that Tube used to have a much higher allocation, but with the drawdown in the stock price, and given what you mentioned about attractive SOTP valuation, why are we not adding to that position then?
We'll see.
Great. Right, moving on. So one question on Titan, given we've trimmed it down quite significantly. So the question is that we've spoken about our concerns on lab-grown diamonds, and thus obviously we reduced our allocation. The question is, otherwise it's a quality compounder, with a very strong brand. So far, the impact of lab-grown diamonds has not played out. I don't know. You can throw some light on how you see it going forward. But why don't we hold it at a reasonable allocation and just use our coffee can philosophy on such a high quality compounder?
Look, I mean, has there anything changed in our view of the management team's quality? Not at all, not even 1%. I think we regard the management team at Titan really, really highly in terms of their capabilities, awareness, agility, etc. So there's nothing that has changed there. It remains, as far as that one attribute is concerned, it remains a coffee can. In terms of the LGD risk, which, as I said, was the biggest part. First and foremost, will it play out as a theme? That's one question mark. If it doesn't, I think it will be, in hindsight, a mistake to have trimmed down because of that risk. But if it does, then let's weigh the risk rewards. Will Titan be the one who will participate in creating trust around LGD if LGD is to become a trustworthy proposition for the wider consumer? If yes, then we believe there is a massive cannibalization risk in the short term, which, despite being a very high quality management and a very deeply moated existing franchise, it's difficult to overcome the cannibalization risk in the short term. That cannibalization risk could be in terms of revenue. Most certainly, it can play out in terms of margins for the consolidated entity, either because of the blend of the margin or because of pressure on the incumbent business margin, right? So that's the other side of the risk reward. So given the extreme impact that the play out of the risk can have on Titan as a business, because this is not a business where watches derive 40% EBITDA or 30% EBITDA and eyewear derives another 20%. 80-90% of the EBITDA comes from jewelry. Within that, predominant part comes from studded, which is diamond, right? So that's one very big piece. The second associated piece, which at least in the near term, we expect it to keep playing out, is as long as the gold prices remain elevated, competitive intensity from gold competitors will remain high, which has happened in the past as well, just that the time period for which gold prices have and the quantum of gold price rally that we have seen in the last, I would say, 12, 18 months has been a little unprecedented of sorts on certain dimensions. And hence, I mean, it did happen once, I remember, 13 years ago, 12 years ago, and there was a massive adverse impact even at that point on margins, which we do see playing out as we speak. So despite their, let's say, if you come to Titan's earnings growth, you can see the -5% on the revenue growth of, I think, mid-20s, right? You can see Titan third last row. It's a -5. Combine all of this with its current valuation. It's at 70 times plus. As I said previously, had it been at 20, 30 times, I would have said some of these risks are already discounted in the price. It's a 70 times plus, and we've got earnings growth headwinds in the near term, which are probably not 1 or 2 or 3 quarter phenomenon, can become a little longer in terms of time period as a phenomenon. And we were on the side of caution. Again, had we not had substitutes, maybe we wouldn't have trimmed it so aggressively. We've done it at least so far, I can say it's a very short time period to call any decision a success. But so far over the last 12, 15 months, I mean, it's still below the levels at which we trimmed. So it has it's all right. The bigger worry on such a decision is more a Bajaj Finance rather than a Titan, I would say.
Right. Also, I think given where valuations are and moderation in overall earnings growth, again, that point about risk reward within the portfolio, there might be other opportunities where we can allocate more, and for the time being, remain at a lower allocation in Titan till the time the risk reward becomes more attractive.
Yeah.
Right. So now, can you throw some light on earnings growth expectations of at the overall portfolio level over the next couple of years, and in line with that, given what you spoke about valuations right earlier, broadly, what sort of earnings growth, what sort of a range of earnings growth are we looking at, and given where valuations are, what's your outlook on what the portfolio can do in terms of returns?
So rather than pointing towards specific numbers, because one is very difficult to point towards specific numbers on a 12, 20, 24-month basis. And it's also not, I mean, we'll get into trouble if we do that kind of a commentary. But let me put it out like this. The chart on the top left is demonstration of the consistency of compounding of earnings. The consistent compounders, the C and C in the CCP, is actually more on the fundamentals than every 12-month on the share price. So we do expect consistency of earnings, even over a 1 to 3 year, which is a short time horizon, from high quality businesses, right? And I've explained how I foresee the cyclicality and hence the outcome of the chart at the bottom. You can say here as well, earnings growth of quality would have driven the share prices to a good extent. Yes, there would have been some P multiple expansion of quality in general as a universe, which did happen during the last decade or so. Where you see my cursor, earnings growth was healthy, right? As I mentioned, the outcomes were actually very similar to cross-cycle averages, both on earnings as well as the portfolio performance of the quality index. I would say that's a good way to look at prospective outcomes in answer to your question. I'd like to stop there here.
Yes. Right. So I'll move on to a question, which is again, going back to more at a portfolio level. Obviously, last financial year, the churn was very high. Can you give some guidance in terms of what should investors expect in terms of churn going forward?
Churn was high. It was one of, we explained the reasons. I'll summarize it again. The definition of quality in terms of what type of sectors get included in it and what drivers do high quality businesses use, all of that underwent a massive radical change if you compare pre-COVID to post-COVID, right? Again, very quick example, hospitals, hotels, large format retail was not part of the coverage universe. They never generated high ROCEs. Now we've not only got them under coverage, but we've also got investments in them. So like that, there are other sectors as well where, I mean, in lots of manufacturing sectors and lots of export-oriented places, ROCEs were never in the double digits. They are now healthy above 20% on a sustainable foundation rather than just flash in the pan. So that required a pivot. That pivot could have been ideally more gradual over a 2022, 23, 24, 3-year period. It ended up being a far more crunched over an 18-month period. That's why the churn was actually almost zero in 2022 and first half of 23, literally zero in terms of changes in stock list. It was barely a little bit mid-single digit churn related to position sizing. And then there was a mean reversion of that in a way. In the next 18 months, all crunched up, so the churn was high. That period of reset is behind us. There will be changes on an ongoing basis for sure, but not at a rate that we saw during calendar year 24 going forward. So again, the way we said, cross cycle long term, historically we used to say around 15% churn. Today we say more like an 18 to 20, but it won't be a 30, 40, 50% cross cycle churn as we see it today. If things change, this churn might go down to 10 or might go up to 30. We'll see. But at the moment, I don't see any reason why the cross cycle churn will be significantly different from, say, a high teens to closer to 20%, including rebalancing and stock entry exits.
Right. Yeah. So the point on reset over the last 18 months, plus the rebalancing, and sort of a closer monitoring of valuations, etc. I think these 3 points put together perhaps answers another question that came my way, which highlighted the fact that we have no sort of agility in terms of taking action when things change. So I think that answers that question. If you look at the last couple of years, we have taken corrective action. The entire reset is reflective, and the higher frequency of rebalancing as required is reflective of a greater focus on any changes that are required in the short term. So we have about 5 minutes. So quickly, your view on another favorite stock of ours, HDFC Bank, and then we'll end there. And yeah, go ahead.
Okay. So, lots of quick points. I'll make one. Nothing has changed in terms of our understanding of quality of the franchise from downside protection, or let me put it, quality of lending, quality of credit, no change. Upgrade to our view on technology orientation compared to 3 years ago on a relative basis. There is at least one bank in the competitor space which is better on technology in some aspects than HDFC Bank. So HDFC Bank might not be the best on tech, but it is certainly amongst the better ones, and certainly getting better in our view compared to where it was, say, 3-4 years ago. When it comes to the deposit side or the liability side, the way things have evolved in the macro environment with the propensity to invest in various asset classes for the wider customer base of a bank, and that's happening for a variety of reasons, more structural rather than temporary. The I would say ability to garner deposits actually, or the moats around deposit garnering, become far more important in this environment than when just by offering 100 bips higher deposit rate, you could have got a CASA, right? So to that extent, I would actually say HDFC Bank is better placed vis-a-vis competition than in a tailwind-oriented deposit environment previously. Having said that, a lot has changed around the regulatory construct, oversight, strictness, and hence perhaps as an outcome, at least as we see it today, and these things can change, as we see it today, the gap between men and boys in extreme event cases was much bigger, given how lending practices of the broader industry versus the best, the gap used to exist. That gap was much bigger, let's say 10 years ago compared to what it is today. So is there a systemic risk today? I mean, the banking balance sheets are stronger than perhaps they ever were during the last 20 years. So to that extent, that risk of market share or upside risk of market share gain for an HDFC Bank, because some of the larger competitors are shooting in their foot that upside risk is relatively, I would say, lower. Net, put all of it together. The earnings growth expectation from HDFC Bank that existed till 5-6 years ago, today it is a slightly more moderated number, which is reflected in our position size as well. But on the valuation front, I would say there are elements of everything that I said, which we see slightly underappreciated than what it can be as time progresses. So that's why rather than have any other bank, we have HDFC Bank in the portfolio.
Right. Great. So I guess we're out of time. So thanks, Rakshit, for answering all the questions, and thank you to all the participants for putting in your questions in the Q&A box. Apologies to those who put in their questions and we haven't been able to answer them, but rest assured we'll get back to you on those. So with that, we'll bring this webinar to a close. Wish you all a great weekend ahead. Good evening.
Thank you, Arjun. Thanks, everyone.